Retiring on dividends in just 10 years, starting with absolutely nothing. Might sound like a pipe dream, right? But what if I told you it's not only possible, it's within your reach? No lottery wins, no get-rich-quick schemes, and no finance degree required. Instead, this strategy hinges on two simple yet powerful principles: consistency and patience. By leveraging proven investment techniques and harnessing the magic of compounding, you can transform small, everyday actions into a financial future most people only dream about. Stick around, because in this video, I'll show you exactly how to build a portfolio from scratch, turn it into a multi-million-dollar asset, and retire with stable passive income, all starting from zero. Starting with $0 and aiming for a comfortable retirement might feel like trying to fill an empty bucket with drops of water. It seems slow and impossible at first. But what if I told you those drops, when collected consistently, could eventually overflow into a stream? In this video, I'll show you how to turn small, everyday actions into a powerful investment strategy. You'll learn how to start investing with no savings, a step-by-step plan to build a multi-million-dollar dividend portfolio in just 10 years, how reinvesting dividends amplifies growth and turns small contributions into major financial gains. This isn't about luck or shortcuts. It's a methodical approach that focuses on steady habits, smart investments, and the magic of compounding. By the end, you'll see how you can transform today's small efforts into tomorrow's financial freedom. Building an investment portfolio from nothing starts with one simple goal: creating your initial fund. If you're working full-time and finding it hard to save, don't worry. There are ways to grow your income without disrupting your routine. First, side gigs are a game changer. Freelancing online, offering local services, or even leveraging hobbies like photography or tutoring can generate cash fast. Imagine spending just a few hours a week dog walking through platforms like Rover or teaching a subject you're good at on websites like Wisent. A single gig could bring in an extra $20 to $30 per hour. Do this consistently, and you'll have a seed fund in no time. Not a fan of side hustles? No problem. Micro-investing apps like Acorns and Stash make it effortless to start. These apps round up your daily purchases to the nearest dollar and invest the spare change for you. For example, buy a $3.50 coffee and 50 cents goes straight into your investment account. Over time, these small contributions snowball. If you make 50 purchases a month, you could be investing an additional $12.50 monthly without even noticing. Finally, consider reselling unused items cluttering your home. Those dusty gadgets or barely worn clothes can turn into cash. Platforms like eBay, Facebook Marketplace, or even local consignment stores make this process quick and straightforward. It's not about the amount you start with, it's about starting. Whether it's a few dollars from micro-investing, a couple of side gigs, or selling old stuff, every step you take gets you closer to building a foundation for your portfolio. Serious about investing? Then you need the right tools. TradingView gives you advanced charts, price alerts, and real-time data, all in one place. Whether you're tracking ETFs, stocks, or crypto, stay ahead of the game. Check the link in the description. Once you've started your initial investment fund, the next step is building consistency. Think of it as setting up a financial autopilot that keeps working even when you're not actively thinking about it. The key is dollar cost averaging. This simple strategy means investing a fixed amount regularly, regardless of market conditions. Instead of worrying about timing the market, which even the pros find nearly impossible, you spread your investments over time. When prices dip, your fixed amount buys more shares. When prices rise, it buys less. Over the long term, this strategy smooths out market fluctuations and minimizes stress. Let's say you start with just $50 or $100 a month. By automating these contributions, you create a habit that builds wealth over time. Most investment platforms, like Fidelity, Vanguard, or even apps like eToro, allow you to set up automatic transfers directly into your investment account. This ensures you never miss a payment, and you avoid the temptation to spend that money elsewhere. For those just starting, focus on creating a realistic and sustainable plan. Maybe it's as simple as putting aside the cost of one takeout meal or a few morning coffees each week. The important thing is sticking with it, no matter how small the amount might seem at first. With time, this consistent investing grows beyond what you put in. It's not just the $50 or $100 a month, it's the compounding growth that makes the difference. As your portfolio grows, the dividends generated by your investments will start to cover more and more of those contributions, effectively helping you reinvest without adding additional effort. Automating your monthly contributions isn't just convenient, it's a way to make investing a priority, even on your busiest days. And when you combine this discipline with a long-term perspective, your small efforts today will lay the groundwork for substantial wealth tomorrow. Want to invest globally without losing money on currency conversion? Wise gives you the real exchange rate with low fees, so more of your money goes into investments. Sign up today. Link in the description. With your monthly contributions set, the next step is deciding where to put your money. This is where your portfolio takes shape, balancing growth and income through smart, diversified investments. When building a portfolio, you'll often hear about two options: individual dividend stocks and dividend-focused ETFs, exchange-traded funds. Both have their advantages. Individual dividend stocks. These give you complete control over where your money goes. You can pick companies you trust, research their dividend history, and invest in stable sectors like utilities, consumer goods, or real estate. Companies like Wendy's, American Tower Corporation, AMT, or regional financial firms like Regions Financial Corporation, RF, are examples of businesses that have shown reliable payouts. Dividend ETFs. These are baskets of dividend-paying stocks, offering instant diversification with a single purchase. Instead of buying shares in just one company, you're investing in a collection of them, reducing risk if one performs poorly. A good example is the Invesco S&P Midcap Quality ETF, XMHQ, which blends solid dividend-paying companies across various industries. If you're someone who wants a hands-on approach and enjoys researching companies, individual stocks could be a rewarding option. But if you prefer a more passive strategy or don't have time for deep research, ETFs can provide excellent returns without the hassle. Here's a sample portfolio combining both options. XMMHQ, Invesco S&P Midcap Quality ETF, offers diversification and steady growth with a strong dividend yield. AMT, American Tower Corporation, a REIT, real estate investment trust with consistent dividends and exposure to real estate. Wendy's, a well-known brand with a track record of rewarding shareholders. RF, Regions Financial Corporation, a stable financial sector stock with strong dividend performance. CubeSmart, a REIT specializing in self-storage, combining stability with growth potential. Together, these investments balance a current dividend yield of around 4.89%, with a dividend growth rate of 19.63%. That means not only do you earn income today, but those payouts are likely to grow significantly over time. A diversified portfolio spreads risk. Instead of relying on one company's success, you're protected by the collective performance of multiple businesses. This is especially important when aiming for long-term goals, as markets can be unpredictable. ETFs offer built-in diversification, while individual stocks let you focus on industries you believe in. Start by splitting your monthly investment between dividend stocks and ETFs. For example, if you're investing $200 a month, you might allocate $100 to an ETF like XMHQ and divide the other $100 among individual stocks like AMT, WEN, and RF. As your confidence grows, you can adjust your allocations or explore other dividend-paying assets. This combination of stable ETFs and high-growth stocks creates a portfolio designed for both immediate income and long-term wealth. And with the power of reinvesting dividends, which we'll discuss next, your portfolio can start working harder for you with every passing year. Once you've built your portfolio, the real magic begins with something called a dividend reinvestment plan, DRIP. This strategy is all about turning your dividend payouts into additional investments, creating a snowball effect of compounding growth. DRIP automatically reinvests the dividends your investments generate to purchase more shares of the same stock or fund. Each reinvestment increases the number of shares you own, which in turn earns you more dividends in the next payout cycle. Here's an example. Imagine your investments pay $100 in quarterly dividends. Instead of withdrawing the cash, you reinvest it to buy more shares. By the next quarter, you own more shares, so your dividend payout grows. Over time, This cycle builds momentum, compounding your portfolio's growth without any extra contributions. Compounding is like planting a tree. At first, it grows slowly, but as time passes, it produces seeds that grow into more trees. Eventually, you'll have a thriving forest. Here's what that looks like in numbers. If you invest $30 a day, about $900 per month, your total contributions after 10 years will be around $93,000. With reinvested dividends and average market growth, your portfolio could grow to $200,000. After 20 years, the same portfolio could exceed $820,000, paying over $40,000 per year in dividends. Most brokers like Fidelity or eToro make it easy to set up DRIP. Once enabled, your dividends are reinvested automatically without you lifting a finger. If your broker doesn't offer this feature, you can manually reinvest the dividends, but automation ensures you never miss an opportunity to grow your portfolio. The beauty of DRIP is how it transforms passive income into active growth. Every reinvested dividend accelerates your portfolio's progress toward financial independence. With brokers making the process seamless, you can sit back and watch your investments grow. With DRIP, your portfolio becomes a self-sustaining growth engine, turning today's small steps into a future of financial freedom. The goal of retiring on dividends in 10 years is challenging but achievable with the right approach. By targeting $1,500 or $2,000 per month in passive income, you can cover essential expenses and enjoy financial flexibility. Here's how you can make it work. To generate $2,000 per month in dividends, you'll need a portfolio of about $600,000, assuming an average dividend yield of 4%. Achieving this in 10 years requires starting small and increasing your contributions over time. Start by investing what you can afford, even as little as $20 per day. As your income grows, increase your contributions gradually. By the midpoint of the decade, aim to contribute closer to $70 or $80 daily. Over 10 years, this consistent effort, combined with reinvested dividends and average market growth, can grow your portfolio to the $600,000 target. At the 10-year mark, a $600,000 portfolio with a 4% dividend yield will generate $24,000 annually, or $2,000 a month. This passive income can provide financial security, allowing you to retire or significantly reduce your workload. The key to success is discipline. Start small. Automate your investments and steadily increase contributions as your finances improve. Every dollar invested moves you closer to your goal, proving that even a modest start can lead to substantial results over time. Want to know which ETFs can supercharge your portfolio for 2025? Click the video on your screen now to discover top-performing options that can help you hit your financial goals even faster. And if you're serious about building wealth, make sure to subscribe. We've got more proven strategies and insider tips to help you retire sooner than you think.